Imagine this. You are a first home buyer. You have spent years saving. You have done everything right. And the government just announced a brand new policy designed to help you get into the market faster. So why does it feel like the door just got harder to open, not easier? That is the strange situation playing out in Australia right now. Labor has rolled out what it calls a housing affordability fix. But economists, banks, and property analysts are warning it could do something nobody wanted. It could freeze the market. So in this video, we are going to break down exactly what Labor has done, why some of it could help, why some of it could hurt, and what it actually means for everyday Australians trying to buy, sell, rent, or invest in property right now. Let's start with what actually changed. In the May 2026 federal budget, the Labor government announced two major changes to property investment in Australia. First, negative gearing on established residential properties is being restricted from 1 July 2027. If you buy an established investment property after budget night on 12 May 2026, you can no longer use rental losses to reduce your wage income. Those losses get quarantined and can only be offset against future rental income or property capital gains. Second, the 50% CG discount is being replaced. From 1 July 2027, the discount gets swapped out for cost-based indexation and a 30% minimum tax on real capital gains. That applies not just to property, but to shares, ETFs, and most other CG'd assets held by individuals and trusts. There are important exceptions. New builds keep full negative gearing access. Investors who buy newly constructed properties can still offset losses against wages and choose whichever key G treatment suits them better. Existing investment properties are also grandfathered, meaning nothing changes for current owners until they sell. And superannuation funds, widely held trusts, and build-to-rent developments are also carved out. So on paper, the policy is trying to do something sensible. Redirect investor demand away from established housing that first home buyers compete for, and toward new builds that add actual supply to the market. That sounds logical. But here is where it gets complicated. The grandfathering rule, which protects existing investors, accidentally creates what economists are calling a lock-in effect. If you already own an investment property, and selling means losing your grandfathered tax treatment, your rational move is to hold. Not sell. Stay put, which means fewer established properties coming onto the market. Which means less supply for buyers, not more. Westpac has warned that investor demand could fall by 34%. Property turnover could drop by 20%. Stanley has said prices could fall 5 to 10% if investor demand contracts sharply enough. CBA has already revised its dwelling price growth forecast down to around 3% for 2026, dropping from a previous estimate of 5%. ANZ is forecasting Sydney prices to finish 2026 down 0.7% and Melbourne down 1.7%. And auction markets are already showing the strain. In May 2026, the combined capital city auction clearance rate hit 52% nationally. That is the lowest since April 2020, during the COVID lockdowns. Sydney came in at 49%. Brisbane fell to under 40%. More than 1,350 auctions went uncleared in a single week. Buyers are hesitating. Investors are pulling back. Vendors who expected strong prices are choosing not to list rather than accept lower offers. And when all three groups pull back at the same time, the market does not correct. It freezes. Now, some of that is not entirely Labor's fault. The Reserve Bank raised interest rates 3 times since early 2026, reversing most of last year's cuts and pushing the cash rate back to 4.35%. Consumer confidence, according to Ann's Roy Morgan, recently hit its lowest level since the survey began in 1973. The Middle East conflict has pushed inflation higher and added global economic uncertainty on top of domestic pressure. So Labour's housing changes landed in the middle of a market that was already wobbling. The policy did not create all of this, but it added to the uncertainty at exactly the wrong moment. And here is the deeper problem that the policy does not fully solve. Australia has a housing supply crisis. The National Housing Accord set a target of 1.2 million new homes over 5 years from mid-2024. According to the National Housing Supply and Affordability Council, progress is already running about a year behind. Building approvals in April 2026 fell another 3.4% month-on-month. Construction costs are still rising at around 4.4% annually. Developers are finding it harder to make new projects stack up financially. Meanwhile, rents are still rising. Net overseas migration in the year to September 2025 was 311,000 people. Population growth is not slowing fast enough to give supply a chance to catch up. So even as the sales market softens, the rental market stays tight. That creates a particularly painful squeeze for renters who were hoping a cooler sales market would translate into easier rentals. It is not that simple. Fewer investors buying means fewer rental properties being added to the market over time. Less supply of rentals. Continued upward pressure on rents. According to Cotality, Australia's housing affordability reached new lows by the end of 2025. Home values have risen roughly 47% since March 2020. The median multiple for Australia, which divides median house price by median household income, was 8.2 in September 2025, firmly in the severely unaffordable range. Sydney's median dwelling price sits at around $1. 75 million, making it the second most expensive housing market globally. World Socialist website The First Home Guarantee, which allows buyers to purchase with just a 5% deposit backed by the government, has been expanded to remove income limits and raise property price caps. In Sydney, the cap is now $1.5 million. On paper, more Australians can access it, but Treasury's own modelling predicted demand would surge more than 30% above existing levels in the scheme's first year. Since Labour's expansion of the First Home Buyers scheme, prices of lower-cost homes have risen 50% more than those of more expensive properties. The policy meant to help first home buyers get in cheaper is helping push up the exact price bracket they are trying to buy in. World Socialist website So, what does all of this mean if you are an everyday Australian trying to figure out your next move? If you are a first home buyer, the market is genuinely softer than it was 12 months ago. Fewer competing buyers, lower clearance rates, and vendors who are adjusting their expectations. That is not a disaster for you. But do not assume the price falls will be dramatic or permanent. The structural shortage of housing in Australia has not gone away. If you are an existing property investor, the grandfathering protects you for now. But it also makes the decision to sell harder, because once you sell, you lose that protection. Get clear advice on whether holding, selling, or restructuring makes sense for your specific situation before July 2027. If you are thinking about buying a new investment property, the rules are genuinely different now. New builds keep their tax advantages. Established properties do not. Your decision should be based on whether the asset itself makes financial sense without relying on the tax treatment as the core reason to buy. And if you are a renter, the honest answer is that nothing in this policy package is likely to give you significant short-term rent relief. The supply problem is structural and takes years to fix. The measures aimed at new construction are moving, but slowly. The bigger picture is this. Labour's housing policy is trying to solve a real problem. Australian housing is among the least affordable in the developed world. The policy is attempting to shift investor incentives away from established stock and toward new supply. That logic makes sense. But the execution has created uncertainty at a moment when the market was already fragile, and the lock-in effect from grandfathering could actually reduce the number of established homes available to buyers for years to come. A cooler market is not automatically a more affordable one. And a freeze is not the same as a fix. Subscribe to Money Made Australia for more honest breakdowns of what is actually happening with Australian property and money. And comment below, do you think Labor's housing changes will help first home buyers or make things harder? I want to know what you think.